Also back with us, Jim Paulsen, Chief Investment Strategist at Wells Capital Management, which has $375 billion under management. Jim has been named top economic forecaster by Businessweek and was Bond Week's interest rate forecaster of the year. And Money Magazine has said his newsletter is one of the 101 things every investor should know. So, Jim, what should an investor know in this volatile market environment?
It is volatile, Carol. It's tiresome and it's anxiety-prone when it keeps going like a yo-yo. I guess I still think, for all the bad stuff that's come down the pipe here, where the markets, where they close today, are still going to be in the United States, less than 10% from their recovery highs here. This still looks more to me like a refreshing pause in an ongoing cyclical recovery than it does the start of a brand new crisis. But it's certainly gut-wrenching. And I would take today, days like today when it really hits a downdraft, to take an opportunity to look to add to risk areas in my portfolio. And then when it rallies, maybe just stand put. That's kind of where I would point investors in that direction.
Let me ask you, though, what gives you that confidence, Jim? Because, yep, it is a volatile market. When we look at what's going on in Europe, and some people say, it's just maybe a matter of time before the United States faces its own fiscal mess. So what really gives you that confidence?
Well, I think one thing, the biggest thing, is we've got a global recovery going on as opposed to a globe which is slowing down. And that can cover up a lot of sins and a lot of problems. Most parts of Europe are indeed growing, not contracting. I think that helps the situation. I'm impressed that since they come out with the $750 billion to $1 trillion backstop, Carol, that they have brought the borrowing rates down in those countries. The 2-year government note in Greece was 18%. A couple weeks back, it's come down to 7 and held there. In Portugal, it was 6. It's come down to 2.5. Spain, it was 3. It's come down to under 2. So the backstop has done what it was supposed to do. That is, provide less than prohibitive rates for these countries to roll over their debts. And the threat of that $1 trillion buyer, I think, is keeping the CDS traders that might drive rates up at bay a little bit. I think we got a problem with the euro. That's going to find a bottom eventually. Right. But I think the basic problem of liquidity, I think, has at least so far been addressed by this backstop.
I think you're definitely right that the euro eventually will find a bottom. Eventually, right? The question is where and when is that going to happen? Markets which were green earlier and maybe made you feel a little bit stable have made you feel a little bit queasy. Yeah. I think Jim is feeling a little queasy when he sees this happening. Maybe yesterday a better day for you, Jim, on Monday when you felt bad at lunch and you felt better at 4?
You bet. But I do think, Matt, that in many ways since the flash crash, this is more about the fact that flash crash happens, and it gives you an uneasy feeling in your stomach as you move towards the end of the day. Could this thing, it's fine now, but it can fall 200 points before we close. This is almost more about volatility than it is about new crisis. We've gone all over the place for the last couple weeks, but most markets are not even, down 10%. But they feel like they're off 30 or something, after getting through this with such volatility every day.
And Jim, let me ask you about something. Michael mentioned Lehman 2. We've been talking about it today here on Bloomberg TV, writing about it at Bloomberg News downstairs. It's interesting because European financial institutions had write-downs of $542 billion after the credit crisis of 2008, and they're looking at $2.3 trillion in exposure to Greek, Spanish, Portuguese, and Italian banks now. Isn't it a concern to you? I mean, the banking system over there looks fairly exposed and fairly fragile.
Well, I think, Matt, this is different than Lehman 2. I think for the most part, we're not, in this crisis, it's not about truly toxic bad debts that need to be written off so much as it is about liquidity for these governments to continue to roll over their existing debt. I think it's a little different situation. The backstop is not TARP dollars.
You mean a default would be okay for them to deal with? It wouldn't be very difficult?
Well, I think that's one possibility. I doubt we come to that because I think right now, as I said, that backstop is allowing these governments to keep the finance rates or the rollover rates at reasonable levels. If it does come to that, we're not talking about $2.3 trillion of exposure. We're talking about a small fraction of that in a restructuring that may go off the books. I just like to throw out that there are two sides of this trade. It does concern me, Matt, and we could have some bad outcomes with restructuring that could affect the markets. But there is two sides to this trade, and that is to say that traders know every night if they want to trade downward for the Armageddon trade, they risk that the good economic reports could continue to put a bid under this market, and or the euro at some point could find a bottom. Maybe it's going to be government intervention that gives it a bottom. But we clearly have seen in recent trading days when a bottom in the euro's found, markets take off.
Hey.